Welcome back to Morning Trade Live. It's time to go inside out on retail as the tariffs been inspecting, certainly hitting a lot of these names and hitting pretty much everything hard, but retail in particular. Zach Waring is with us, equity analyst from CFRA Research. I'd like to hear your big picture. Of course, we've got a bright spot with Vietnam doing some negotiations on Friday, only to hear Peter Navarro this morning still continue to say that the zero tariffs aren't really the story, that it's good, but we need more from Vietnam. So not fully happy there. I did see that LULU and Nike are in the red today after having been a bright spot late last week. Some of your big picture on what's going on with these apparel brands.
Yeah, thanks for having me. So, really in the last week or so, you've really gotten news from the administration that no one's safe. Originally China and, Mexico and Canada were the first targets. And a lot of companies had diversified away from those countries. But, with the sweeping tariffs, they basically caught all apparel companies off guard. So no one's really safe. We do like companies that sell a lot of, their goods outside of the U.S. right now. If you're looking to kind of stay away from those tariffs, we like companies like PV revenues outside the U.S. Nike is shielded a little bit because they also do a lot of sales globally. And we like some of these companies like Lululemon, like you said, who we think can kind of beat the tariffs just through pricing.
So at this point now, tell me more about the names. So you mentioned, I heard you say Nike and Lulu. Are there more that you feel comfortable with at this point versus over others that could be possible winners eventually?
Yeah, so we really think the entire sub-industry is getting extremely cheap. And we know that tariffs are going to really impact these companies because, they produce most of their goods in Asia, and all those countries were really hit hard with those tariffs. However, valuations are at very low levels. Haven't seen these valuations since COVID lows. And we think for a lot of these strong growth companies in apparel, that creates a great buying opportunity for long-term investors. PVH, Nike, Lulu, those are some of our top picks in the space. They're all global players, and a lot of them, get a lot of their revenues outside the U.S., which really shields them from these tariffs. But valuations across the sub-industry are extremely low.
So the concern here is people have cash on the sidelines and they're trying to pick bottoms, which no one can ever pick a bottom. How do you get in and say, I want to put my cash to work? I think it's a good time. You're mentioning, I saw Zach Waring. He's really smart. He liked some of these retail names. I mean, do they start to get in today when Nike's down 6%, or how should they go about that?
Yeah, I absolutely think, right now is a good time to start, buying. I wouldn't say, stick your whole neck out and use all your cash here, but I do think that it's time to start nibbling here. These companies, even with the tariff impact, these companies are trading at extremely low valuations. So, a lot of the risk has been taken out on these companies. They traded down 20 to 30%, last week alone. So I do think you would, if you're a long-term investor, I think you have to start putting money to work here.
And what about confidence in the market overall? I mean, we saw Warren Buffett shoring up cash in a big way before this whole thing happened. I know you have a wide array of names that you cover, not only retail, athleisure. What's your big picture on maybe some of the other sectors or how this plays out this week?
Yeah, obviously it's very volatile right now, but I think that's the best time to buy, and especially if you can find really good companies at really cheap valuations. I wouldn't be buying, very risky companies that aren't doing well currently, because obviously they're the ones that are going to be hit the hardest. But I would be looking to put some cash to work in companies that are really good, growth. They have good operating metrics, good margins, because they're going to be the ones that have the most room for these, to maneuver these tariff impacts and still maintains, somewhat decent margins. So, I'd really be looking at really quality companies. That's kind of like, kind of where we have our buy ratings, and our strong buy ratings are in really quality companies that have growth and have a lot of international revenues.
Zach, just quickly, and I want to get to the trades that Tom White has of some of the names that you're talking about, but are you comfortable saying some of the names that you find to be more risky when it comes to retail, the names that you probably wouldn't touch right now, stay away from?
Yeah, so we do have a couple of companies that we don't really love right now. Under Armour's one of them. Obviously, they've had issues over the last few years with, margins and, revenue declines, and they've done a lot of restructuring. So companies like that we just would stay away from because, these margins or these tariffs are really going to impact those companies who are already struggling.
All right, thanks for that. I think that was worthwhile to put that in the list. Thank you of what to watch for and the no list. And on the yes list was Nike, Lulu, PBH, Zach Waring. Thank you of CFRA Research. We appreciate it. We bring in Tom White, host of Fast Market here. He has some example trades. You're combing through the Nike story here, which had a bright spot late last week. This morning, I started to think it was going to be a winner. I saw it on the map. It looked green, only to see it in the red now. It's down 6%. It's already trading wildly. Some of your thoughts on this?
Yeah, you take a look at it, it's at 7-year lows, Nicole, and it's been just a falling knife over the last several years as competition heats up from On Holdings, Hoka brand, from Deckers Outdoors, and then, they've had inventory issues. They've had a pullback in sales in China. Now you got the tariff news. So 7-year lows, not surprising that the stock's sitting there. The new CEO trying to turn things around. So I looked at a strategy that, maybe a paid to wait type of strategy. Zach mentioned that they might be dipping their toes in here in Nike. Well, this is a strategy that allows you to do it while getting paid to kind of wait. If it at least consolidates, maybe grinds up a little bit. So I looked at a covered call strategy here where for every 100 shares of Nike stock that you buy, you sell an out of the money call to the upside on this. I went out to the May 2nd weekly options here. It's about 25 days to expiration on this one, where I'm going to, every 100 shares of stock I buy, I'll sell one of the 60 strike calls in the May 2nd weekly options. That creates a credit there. So my debit that I'm going to pay on that's going to be about $52 or $52.20. That's going to be your break even to the downside. So you're buying the shares at about a 3% discount to where the stock's currently trading, and you're selling that upside call. The dividend yield near 3%, the dividend yield. So that creates that yield, that extra yield, along with selling the call up above the market at the 60 strike. Now you're capped out of gains above the 60 strike, but as you get closer to expiration over the next 3.5 weeks, you'll have that ability to roll or adjust that short call, creating credits, increasing potential profitability, and lowering risk on this trade. So it's a paid to wait type strategy, covered call here in Nike if you still believe that the turnaround's there, but even if it just consolidates, you can be profitable on this trade.
Yeah, understood. So everybody likes a dividend yield. You get paid to wait, but you made the note that this is at 7-year lows. Thank you for that. Neutral bullish trade. I believe that's what that was. And we just take a look also at Lulu, a similar trade, right, that you have for this one.
Yeah, it's still neutral to bullish, but it's a don't be a hero type of strategy here, trying to take advantage of that high implied volatility that we're seeing in the overall market and this name. The stock's down over 30% in 2025 after falling pretty precipitously from a year ago. Now, we got a nice rally into the earnings a couple months ago, but now we've pulled back pretty sharply, and the tariffs are really going to impact them. They produce a lot of their product in Southeast Asia, and that's a concern. So maybe don't want to be aggressively bullish on this one, just due to macro environment that's going on also. So I went out to the April 25th weekly cycle in this one, really short-term positioning, about 18 days to expiration, where I'm just going to sell an out-of-the-money put vertical, selling the April 25th 240 strike put, and then to make it risk-defined, you want to stay risk-defined in all types of environments that we're seeing right now. Buy the 230 strike put, so a short $10 wide neutral to bullish put vertical. You're collecting roughly about a $3 credit on it, so that takes your break even down to 237 over the next 2.5 weeks. That's about 5% below the current share price. So you're giving yourself a better probability of success. That 237 break even, you got about a 60% probability of that being out of the money at expiration, which is what you want on this one. You're risking $700 to make a potential $300, and you profit in 3 out of 4 scenarios on this type of strategy, Nicole, taking advantage of that higher IV going on right now.
Yeah, Tom, just quickly, I mean, you know, the president just said you have to take the medicine to fix something. A lot of naysayers this morning, many of the big market leaders that we know well. I just wanted to give you a moment to touch on this. This is the EU is out now, and we know that many countries are reaching out to the president for negotiations, including Japan, for example, but that the EU now saying zero tariffs for cars and industrials, and that there are some talks going on. I certainly don't know the details, but just a quick thought here about the markets and or the tariffs.
Yeah, I think everybody kind of agrees that maybe some of this negotiation needed to take place. I think the way that they went about it, as far as the administration is going about it, is probably, you know, the reason that we're down so much now. That being said, we had 2 straight years of solid gains, right? We were overbought, you know, on a valuation basis for the equity market. So I'm not sure that I totally agree how they're doing it, but I think we need to start seeing some headlines that say, hey, these countries are negotiating with us, and you know, they are going to reduce some of their tariffs and some of their barriers to trade. That's going to be, I think, the big thing. You know, the Fed's meeting at 11:30 Eastern time today in a closed door meeting. Maybe we'll get some commentary out of that. But at the same time, you know, this is going to be that environment when you've got the VIX above the 50 level or near the 50 level. It's going to kind of signal the fact that we're not out of the woods by any stretch of the imagination. And it just seems like the administration wants to keep pushing this narrative that's hurting equity markets at this point. But we were overdue for a pullback. If we can start kind of right the ship here, maybe consolidate a little bit, maybe that would help the sentiment out there as far as what investors are seeing at this point.
And now we are at the levels for the S&P 500 back to December of 2023. Tom White, thank you. Good to see you.